Let's focus on today's big winner. It's energy again. The sector rallying after OPEC sticks to its plan to only gradually raise oil output. WTI and Brent are surging about 3% today. WTI is at $78 a barrel. That's a 7-year high. Every member of the energy sector is in the green today and for the year. My next guest says expect even higher oil prices given the current underinvestment in crude. Joining me now is Stan Major. He's portfolio manager of the Hotchkiss and Wiley Midcap Value Fund. Stan, it is great to have you here. And boy, is this a hot area all of a sudden. What would you tell investors who think that this is the place to ride into year end?
Sure. It's great to be here, Kelly. Yeah, as you mentioned, all of a sudden, this has been called 5 to 10 years in the making. When you look at the energy sector, we've seen a lot of underinvestment. So today we're spending half as much as we did 5 to 10 years ago, but we're consuming more, even with COVID. So there's been a lot of underinvestment. What that does is, with pretty good demand is strengthening as we're coming out of COVID. Productive capacity is declining. We're just not spending enough money to keep capacity up, whether that's in the U.S. or OPEC, OPEC plus. And so we've got a very tight market. The interesting thing about today, I've been covering this for 25 years, is that historically, when you've seen good prices, when you've seen good returns, you've seen capital come into the business. Mm-hmm. So simplistically, if you think about a balance sheet, if you want capital to come into the business, you need to raise debt and equity on one side of the balance sheet to finance assets. So you usually see that when things are good. We're seeing the opposite today. So we've got a tight oil market, but oil companies are doing the opposite. They're paying down debt. They're returning capital to shareholders. So the asset side is not increasing. And so that makes this a very interesting market where this tightness can continue.
I have about 38 questions for you. So let me try to get, for our audience who kind of just wants the picks, let me get this out there right away. You like Marathon Oil, which has doubled this year. You like Penn Virginia, which has tripled. You've got names like Cairn Energy, Vistra, NRG, Cosmos, as, 2 to 3% holdings. So, I just want to discuss with you these comments from the IEA today, from Fatih Birol, who just said that the spikes in energy that we're seeing, he was talking more specifically about nat gas, but I want to ask you the question broadly speaking. He said they have nothing to do with the world's transition away from fossil fuels. Is that accurate? Is the underinvestment only because people want a strong return? Or to me, is it quite obviously because there's a massive divestment push away from fossil fuels happening as well?
I would say just think about it in common sense. So energy is a very long lead time business. If you think about deep water, it will take you 10 years before that project comes on. With so much uncertainty about crude oil demand in 2031, people just are not spending the money today. So maybe he's making the case that directly today, it's not the transition to fossil fuels, but psychologically, people are not committing long-term capital. And so I think that does have something to do with what we're seeing today. I think it's early signs.
So the knock-on question that I then have is one about investment returns. There are people writing that if the fossil fuel industry just returned cash to shareholders, they could generate tremendous financial returns. Sort of like what we saw with Altria over the past 15 years or so. But if they try to invest in order to keep up with the changing times, that in a way presents more investment risk, even as places like Engine Number One are pushing Exxon to pursue those strategies. Do you, as an investor, have a preference in terms of which path you'd like them to take?
We absolutely do have a preference. So if you think about the math about what you're asking, currently these companies, you mentioned Marathon, they're generating significant amounts of free cash flow. The companies we're invested in are generating 20% of their market cap in free cash flow. So massive amounts. So $2 billion of free cash flow, the market caps are $10 or $11 billion. So when you think about that, they're taking that capital and, unlike the past, returning it to shareholders. So if you think about a share buyback plan, which we favor over dividends, a company can buy with a 20% free cash flow yield, could buy their entire shares outstanding back in 5 years. That's incredible. Additionally, the business should consolidate. So as if you look at the Permian, the Eagle Ford, the Bakken, there's 30 or 40 companies. There should be 2 or 3 or 4. And so with consolidation, you also get efficiency and higher profitability also. So there's a lot of things going right. And we think if they focus on the right side of the balance sheet, pay down debt, buy back stock, it's not going to grow production. It can be very good for investors.